Trading in emerging market currencies grew faster than the major global currencies over the last 3 years. It now makes up for nearly a quarter of all global FX trading and averages around $1.6 trillion a day. The Chinese renminbi retained its position as the most traded EME currency, but currencies from other Asian economies, including the Indian rupee, the Hong Kong dollar, and the Philippine peso, experienced even sharper gains. The increase was largely driven by the growing demand for emerging market assets by global investors and the continuing trend of electronification of global FX markets. Trading in non-deliverable forwards, or NDFs, was particularly pronounced and has almost doubled over the last 3 years. NDFs are contracts that are typically traded offshore. They allow agents to bypass currency restrictions that are common in many emerging markets. The increase in NDFs went hand in hand with the continuing dominance of offshore markets for emerging market currencies. Offshore markets are now larger than domestic markets in most cases and by as much as 3 times larger in some regions. Offshore markets increase liquidity and diversify market participants. This in turn makes it easier to trade, invest, and hedge risks. But our estimates show that during times of global market stress, offshore markets tend to take over and drive movements in onshore markets. This is a concern for central banks as they have generally focused their monitoring and intervention activities on domestic markets. Many central banks are already rising to the challenge and expanding the scope of their intervention and monitoring activities.